Loss is not a personal failure. Loss is a data point that reveals how your decision engine behaves under uncertainty. Markets will always serve streaks of randomness and volatility, and no configuration of indicators can delete that reality. What separates fragile performance from durable performance is not the absence of red days, but the presence of a disciplined method for absorbing them. The untrained mind treats a loss as a verdict on identity and then reacts with denial, bargaining, or impulsive action. The professional mind treats a loss as an invoice for operating in a probabilistic arena and then responds with predefined steps that convert pain into information and information into refined execution. In this video, you will install that professional architecture. You will learn to uncouple self-worth from outcomes, to normalize uncertainty, and to translate discomfort into structured review rather than chaotic behavior. You will create language for loss that is precise and unemotional, so your brain does not hijack your process. You will design boundaries that protect capital and attention when emotions swell. You will build a recovery loop that returns you to baseline quickly, so opportunity cost does not compound. The goal is not to avoid losing trades. The goal is to lose correctly, at the right size, at the right time, for the right reasons, and to exit each session with a clearer map than the one you entered with. If you want consistency, you must first master the moments when the market says no. This is a blueprint for how to lose money without losing your mind, and it is the path to long-term statistical superiority and a calmer life at the screen. Loss in trading becomes destructive when the mind assigns it the wrong meaning. When a negative result is interpreted as a verdict on identity or competence, the nervous system shifts into protection mode, and the proetic decision engine reverts to primitive patterns. The protective response is fast and emotional, not statistical and deliberate. It reduces attention to narrow cues, elevates urgency, and favors short-term relief over long-term expectancy. In this state, the chart is no longer information. It becomes a mirror for fear, shame, or anger. The first dysfunction is loss aversion expressed as risk-seeking in the loss domain. The mind prefers to avoid the small, certain pain of a planned exit and instead chooses the larger, uncertain pain of holding on. This is a mismatch between biological wiring and probabilistic reality. The bias is strengthened by intermittent reinforcement. Occasionally, a held loser turns around and delivers relief, which teaches the brain that avoidance worked, even though the same behavior will statistically degrade expectancy over time. The second dysfunction is escalation of commitment driven by sunk cost. Once resources are invested, the mind searches for reasons to justify the original decision. Attention filters begin to favor confirming information. Disconfirming signals are discounted or reframed. The position becomes a project that must be defended rather than an instrument to be evaluated. The third dysfunction is the illusion of control. After a loss, the mind attempts to reassert certainty by adding rules impulsively, changing parameters mid-flight, or micromanaging entries and exits in ways that were not pre-tested. This creates a moving target. The system loses coherence and performance attribution becomes impossible. The fourth dysfunction is outcome attachment. When identity and self-worth are entangled with profit and loss, the nervous system treats a losing trade as social threat. Cortical resources that should be allocated to analysis are diverted to self-protection. This produces behaviors like cutting winners prematurely to feel safe and letting losers run to avoid admitting error. The fifth dysfunction is recency distortion. The most recent outcome dominates perception, leading to overconfidence after gains and timidity after losses. Neither state reflects the true distribution of outcomes. Position sizing and selectivity drift in response to mood rather than data, which amplifies variance exactly when stability is required. The sixth dysfunction is attentional narrowing. Under stress, the field of view collapses to a single time frame or a single level. context is lost. The trader reacts to micro movements and noise, while ignoring higher-order structure, session conditions, and risk budget constraints. This accelerates overtrading and slippage. The seventh dysfunction is language contamination. The inner dialogue uses imprecise phrases that smuggle in urgency and entitlement. Words like must, need, and get back activate threat responses and frame the session as a test of worth rather than an execution task. Vague statements such as, "It will probably come back," or "I just need one good move," provide no operational guidance and therefore push action toward impulse. The eighth dysfunction is boundary erosion. Clear limits around time, size, and daily drawdown soften after early discomfort. A trader begins the day with a defined maximum loss, but quietly grants exceptions. Each exception reduces the credibility of future limits. The mind learns that boundaries are negotiable, so they cease to function as constraints during stress, which is exactly when they are needed. The ninth dysfunction is attribution error. Profitable outcomes are credited to skill, while losses are credited to external forces or bad luck. This blocks learning because feedback is filtered by ego rather than measured against process criteria. The 10th dysfunction is narrative, overfitting. After a loss, the mind constructs a story to make the outcome feel inevitable. The story offers emotional closure but replaces statistical inquiry with hindsight certainty. Rules are then edited to fit the story, which degrades the integrity of the system. These dysfunctions do not appear randomly. They are triggered by predictable conditions. Elevated uncertainty, compressed time to decide, increased leverage, and social comparison. Each increase cognitive load and prime the protective response. Fatigue, hunger, and accumulated screen time further lower the threshold for impulsive behavior. The common output is a cluster of actions that destroy expectancy. Stops are moved or removed. Positions are increased to escape discomfort. Trades are initiated outside the plan to relieve boredom or frustration. Winners are exited early to lock relief rather than to execute the edge. Sessions are extended to chase a feeling of redemption rather than to follow a schedule. The underlying logic error is consistent. The mind seeks to minimize immediate psychological pain, even at the cost of increasing long-term financial pain. Short-term relief is purchased by selling future optionality. The operating error is also consistent. Evaluation focuses on outcome rather than process. The question presented to the mind is, did it work, instead of, did I execute my edge? This question invites randomness to judge identity and invites emotion to steer the next decision. The structural error is the absence of a stable frame. Without a fixed risk budget, a fixed decision sequence, and predefined stop behaviors, each new moment becomes a fresh negotiation with discomfort. Discomfort wins. Deconstruction is therefore a matter of naming and separating. Loss is separated from identity. Emotion is separated from action. Process is separated from outcome. Each bias is given a precise label so it can be recognized at speed. Each trigger is mapped so it can be anticipated. Each damaging output is translated into objective terms so it can be measured. When the system is viewed in this way, loss is no longer a verdict. It is a diagnostic signal indicating which protocol fired and which boundary failed. Recognition is the first lever of control. Once a bias is named, it loses much of its invisible power. Once a trigger is mapped, it can be addressed with a pre-commitment rather than a negotiation. Once an output is measured, it can be reduced through constraint. The mind stops asking, "How do I win this trade?" and starts asking, which protocol is active and what action preserves expectancy. This is the pivot point of the entire transformation, and it begins with a clean, unemotional map of how loss interacts with human wiring. The pivot begins when loss stops being a verdict and becomes a signal. The nervous system still reacts, but you refuse to assign identity-level meaning to that reaction. You allow sensation to pass without converting it into instruction. You acknowledge that feelings exist, and you revoke their authority to steer execution. This is the first separation. The second separation is between intention and protocol. Intention says, be consistent. Protocol defines exactly how consistency is produced under stress. Without protocol, the mind fills gaps with impulse. With protocol, the gaps are already closed. The third separation is between control and influence. You do not control outcome. You control exposure, timing, and adherence to rules. When the boundary between control and influence is clear, effort migrates to the levers that actually change expectancy. The mental shift is a series of replacements. Replace the question, "Am I right?" with the question, "Did I follow the process as specified?" Replace the question, "How do I fix this loss?" with the question, "What is the next correct step according to plan?" Replace the phrase, "Get it back" with the phrase, "Return to baseline." Replace the frame of justice with the frame of statistics. The pivot also requires a new contract with uncertainty. You stop bargaining with randomness. You stop waiting for certainty that never arrives. You accept that the job is to act with incomplete information while protecting capital and attention. That acceptance removes the hidden demand the market should behave. When the demand dissolves, frustration dissolves with it, and discipline becomes easier to execute. The decision engine is then reconfigured around three anchors. Meaning is recoded so that process quality defines a good day even when the ledger is red. Method is recoded so that rules are simple enough to execute under load and specific enough to leave no room for negotiation. Metrics are recoded so that what is counted reinforces the identity you want to build. You count rule adherence, risk kept within budget, high-quality setups taken and low-quality setups passed. You do not count luck and you do not worship streaks. Languages upgraded as part of the pivot. Vague phrases are removed and replaced with operational language. Instead of "I hope this works," you say the edge is present and the risk is defined. Instead of "I cannot take another loss," you say the next trade is independent and sized within limits. Instead of "I need to be right," you say "I need to execute the plan." This is not motivational speaking. It is defensive coding. The words you use are the interface to your nervous system. Precision prevents hijacking. Pace becomes intentional. After a loss, you do not speed up. You insert a fixed pause. You breathe in a pattern that lowers arousal. You run a short checklist that verifies orientation to rules rather than orientation to relief. You reduce inputs instead of adding new ones. You return to the core timeframes and the core triggers that define your method. By making pace a rule, you deny urgency its favorite doorway. Boundaries become non-negotiable. The daily risk cap is recast as a structural limit, not a suggestion. The session schedule is treated as part of the system, not a flexible guideline. When a boundary is reached, the session ends. This protects future self from the debt created by present emotion. Identity is updated to match the system you want to run. You stop identifying as a predictor and start identifying as an operator. An operator measures, executes, and reviews. An operator is not excited by a win or humiliated by a loss. An operator evaluates whether the machine was run according to specification. This identity is resilient because it is compatible with randomness. Attention management is incorporated into the pivot. You deliberately widen the field of view when stress narrows it. You step back to higher structure, to the session context, and to the risk budget. You treat narrow focus on micro movements as a symptom that requires an intervention, not as a valid reason to act. Attribution is corrected. Outcomes are attributed to both variance and behavior, with clarity about which part belongs to which. This makes learning possible because feedback is not filtered through ego. The pivot ends with a declaration that is also a design choice. You declare that the objective of each session is to protect decision quality and capital quality while allowing the statistical edge to express over time. You choose to win by subtraction rather than addition. You remove impulsive edits. Remove mid-session rule changes. Remove revenge tasks. Remove open loops after the daily review is complete. By removing noise, you reveal the structure. By revealing the structure, you make discipline easier. The next step is installation. Principles become procedures. Procedures become habits. Habits become identity. Identity sustains the system when pressure is high. The moment you stop negotiating with loss and start negotiating with yourself through pre-written rules is the moment the game changes. Professional performance begins when identity is decoupled from results and the role is redefined from predictor to operator. Separation of self from outcome is the foundation because it neutralizes the reflex to defend ego and frees cognitive resources for execution. You treat the trading account as a measurement instrument and your mind as the process controller. The instrument reports variance and the controller adjusts procedures. A loss is a message about distribution and alignment with rules, not a message about worth. This separation is built through 3 layers. The first layer is meaning. You establish a permanent rule that outcome language cannot touch identity language. Statements like "I am good" or "I am bad" are replaced with statements like "the process was aligned" or "the process drifted." You rehearse a compact definition of winning that ignores single trade profit and focuses on adherence to the plan, correct position sizing, and clean exits at predefined levels. You define a good day as a day where risk stayed inside the budget and rules were executed without negotiation. The second layer is metrics. You elevate process metrics above money metrics. You count setups passed because conditions were not met as a positive score. You count the percentage of trades that met every checklist criterion at entry and the percentage of exits taken at the first available valid moment. You count the number of times you paused after a loss and the number of times you rejected impulses that contradicted the plan. You record these counts in plain language so they shape attention. What you count grows in salience, and what is salient shapes behavior under load. The third layer is mechanics. You codify behaviors that keep identity out of the cockpit. You pre-write your maximum daily loss and transform it into an automatic termination rule rather than a guideline. You predefine the number of trades per session and the conditions for session continuation so that you cannot expand risk to repair mood. You pre-commit to a minimum pause after each exit, so there is no space for identity to demand a quick redemption. When the pause ends, you run a micro reset that asks a fixed set of questions about rule alignment and risk posture. The questions are binary and operational because ambiguity invites ego back in. Separation is also a linguistic technology. You intentionally replace phrases that attach self to outcome with operational phrases that attach action to specification. Instead of "I need this to work," you say "the edge is present and the risk is defined." Instead of "I cannot take another loss," you say "the next decision will be sized within limits and judged by rule adherence." This is not cosmetic. Language selects attention, and attention selects action. You also separate feedback channels. Money is observed, but it does not instruct. Process metrics instruct. Number 4. After a losing session, you do not ask "how could I have made money?" You ask which specification was unclear, which cue was misread, and which boundary failed. If the answer is none, you mark the loss as variance and move on. If a specification was unclear, you rewrite it in simpler terms and test the new phrasing in the next session. By keeping money in the observation layer and process in the instruction layer, you stop letting randomness rewrite the system. Emotional separation requires you to normalize the sensations that accompany uncertainty without granting them command authority. You expect elevated heart rate and tension during decision points. You expect a contraction of focus after a loss. You plan a physiological reset that is short, repeatable, and boring on purpose. You breathe to a fixed count. You reorient your gaze to a distant reference to widen attention. And you speak one line that anchors the operator identity. Then you return to the checklist. You do not negotiate with sensations. You let them pass while you execute the next specification. Identity separation is reinforced through closure rituals. At the end of the session, you formally shut down market input and run a brief debrief focused on process metrics. You archive the day with a single sentence that describes the dominant strength to keep and a single sentence that describes the single adjustment to test tomorrow. You do not open platform data again that day. You train your mind to recognize that evaluation has a container and self-judgment is not invited. Over time, this ritual builds trust that tomorrow's operator will have clean conditions. The separation also changes how you handle if there are streaks. A streak is redefined as a cluster of outcomes inside a distribution, not a narrative about talent or doom. You keep position sizing rules invariant to streaks so that identity cannot coax you into expansion after wins or contraction after losses. You keep selection rules invariant so that the quality of setups remains stable while variance plays out. You record the streak as a natural phenomenon and let it pass through you without editing the machine. The final reinforcement is environmental. You design your workspace to cue the operator identity and to discourage identity-based performance theater. Screens show only the timeframes and instruments defined in the plan. Notifications are eliminated. Notes in view are limited to rules, risk budget, and the single sentence that defines a good day. There is no scoreboard of weekly money. There is only a scoreboard of rule adherence. Under this architecture, the mind learns that dignity is preserved by fidelity to specification, not by today's P&L. The reward signal shifts from relief and excitement to quiet satisfaction with clean execution. Losses still occur, but they no longer threaten identity. Wins still occur, but they no longer inflate identity. The system stabilizes, because meaning, metrics, and mechanics all point in the same direction. You become uninteresting to your own ego and highly interesting to your future self, who depends on you to keep the machine intact. A probability mindset begins with a commitment to think in distributions rather than single outcomes. A single trade is noise. A series of trades executed under consistent rules is the signal. When you adopt this lens, you stop asking whether a trade will work, and you start asking whether the set of trades taken under a defined edge will produce positive expectancy over time. Expectancy is the average outcome per risk unit across a sufficiently large sample. It is a property of the method plus the discipline that runs it. It is not a property of today. Edge is present when the combination of selection criteria apprise entry timing, exit logic, and risk control produces an average gain that exceeds the average loss adjusted for frequency. Win rate and risk to reward ratio are not competing ideas. They are two sides of the same equation that produce expectancy. A lower win rate is acceptable if the average win is large enough relative to the average loss. A higher win rate is acceptable even with modest winners if losses are small and rare. The task is not to chase both at once. The task is to choose a configuration that fits your temperament and then protect it from drift by enforcing rules. The mindset requires you to normalize variance. Clusters of wins and clusters of losses will appear inside any distribution. They do not mean the rules stop working within a small sample. They are the rhythm of randomness. The correct response to variance is not to edit rules impulsively, but to ensure execution, fidelity, and sample size. You verify that each decision met the specification. You continue the sequence until the sample is large enough to make an evaluation that is statistically meaningful. You reserve system changes for review windows, not for moments of discomfort. Independence is respected even when the brain insists on pattern. The next trade does not know what the last trade did. Recency feels like information, but it is often noise. The mind wants to increase size after a few wins, and to decrease size or skip valid trades after a few losses. A probability mindset rejects this drift because it decouples sizing and selection from mood. Position size is tied to account risk budget and system risk profile, not to the last outcome. Selection is tied to rule confirmation, not to recent pain or euphoria. This invariance is what allows an edge to express. Risk is managed as an input, not as an afterthought. You define the maximum loss per trade, the maximum daily drawdown, and the maximum number of trades per session in advance. These boundaries shape the distribution of possible outcomes by capping the left tail and preventing behavioral spirals. A stop is not an opinion. It is a structural limit that fixes the cost of invalidation. Targets or exit conditions are not hope. They are the mechanism that converts a favorable move into realized return according to plan. When risk is known before entry, decisions during the trade become simpler because the worst case is already accounted for. The language of certainty is removed and replaced with the language of likelihood and process. You do not need to be right. You need to apply criteria that historically produce a slight advantage and then let the long run do its work. You do not demand that the market reward you now. You require only that you act when the edge is present and stand down when it is absent. Phrases like, "it should move" or "it must go" are discarded because they invite attachment. Phrases like "conditions are met" and "risk is defined" are adopted because they anchor execution to observable facts. Measurement shifts from money to mechanics. You track the percentage of trades that met full entry criteria, the average adverse excursion compared to the planned stop, the average favorable excursion relative to the planned exit, the number of valid setups passed and invalid setups avoided, and the stability of position sizing across streaks. These measures tell you whether the operator is preserving the edge. Money can fluctuate while mechanics remain excellent. Mechanics can degrade while money temporarily looks fine. You protect expectancy by serving the mechanics. Time horizon is clarified. The game you are playing is measured in sequences and cycles, not minutes and emotions. You choose a review cadence that matches your method. Intraday methods may review weekly. Swing methods may review monthly. Each review asks whether the realized distribution aligns with the expected distribution and whether any drift in execution or regime change is detectable. If the edge degrades across a full review window, even with disciplined execution, you slow down, test refinements on historical data, and make changes deliberately. You do not rebuild the airplane mid-flight because of a bump. Overfitting is resisted through simplicity. Rules are specific enough to be testable and repeatable, but not so complex that they capture noise. Each added condition must earn its place by increasing robustness across markets and periods, not just by improving a backtest segment. A probability mindset values durability over perfect past performance. It chooses clarity over cleverness because clarity is executable under stress, and execution is the only path for expectancy to appear in real time. Drawdowns are treated as an inherent feature of any positive expectancy system. You predefine the likely depth and length of drawdown given your edge, sizing, and frequency. When a drawdown occurs within those bounds, you follow the plan and keep sample size flowing. When it exceeds those bounds, you enter investigation mode with calm curiosity. You examine whether volatility, liquidity, or structural conditions have shifted the environment in ways that invalidate assumptions. You respond with rule adjustments only after evidence accumulates, and you communicate those adjustments to yourself in plain language, so execution remains simple. Selection discipline is framed as a cost control function. Each trade spends emotional capital and time as well as money. High-quality filters reduce churn and keep you fresh for the moments that matter. Passing on marginal setups is an active win because it preserves capacity for high-expectancy opportunities. You are not here to trade often. You are here to trade well. A probability mindset accepts boredom and quiet as productive states because they prevent noise from diluting edge. Confidence is recalibrated away from prediction and toward repeatability. You feel confident not because you know what will happen, but because you know exactly what you will do across a range of outcomes. Your confidence lives in your checklist and your boundaries, not in your market calls. This kind of confidence stays stable through variance because its source is internal and controllable. Finally, you anchor identity to the role of steward of expectancy. Your job is to protect the small advantage of your method from erosion by emotion and randomness. You protect it by showing up with the same rules on green days and on red days. You protect it by letting losses occur at the planned size and letting winners run to their planned exits. You protect it by closing the platform at your scheduled time and by reviewing with numbers rather than narratives. When you live this way, the question can shift from, "Did I win today?" to, "Did I increase the probability that the next 1,000 trades will express my edge?" That question liberates you from the tyranny of single outcomes and returns you to the only game that matters. The long game, where discipline compounds and expectancy is allowed to do its quiet work. Process primacy means the plan tells you what to do and when to do it, while outcome is observed without authority to change the plan. You run a machine. The machine is a sequence of definitions, decisions, and constraints that produces a distribution of results when operated consistently. When process is primary, you judge success by fidelity to specification. You allow variance to play out while the edge expresses over time. To make process primary, you first define the frame of operation so clearly that there is no space for improvisation under pressure. You describe the market conditions you engage and the conditions you ignore. You define the signal set, the time references, the instruments, and the risk budget. You set a default state of no trade and require explicit confirmation to leave that state. When confirmation is absent, you remain inactive by rule, not by mood. You then map the decision sequence as a chain with gates. A gate is a yes or no checkpoint that must be satisfied before the next action is permitted. The sequence begins with environment confirmation, continues through setup confirmation, risk definition, the reason about an inch for more now, amount an inch for more of, and timing alignment, and ends with execution and monitoring. If any gate returns no, the sequence terminates. This eliminates negotiation with uncertainty because the choice is not personal. The machine either allows action or it does not. You specify entries as a location and a method that can be executed the same way every time. You specify risk in advance as a fixed unit relative to the account and a precise invalidation condition. You specify exits with two classes of instruction. There is the invalidation exit that caps loss when the method is wrong. There is the realization exit that converts a favorable move into booked return according to plan. You also specify abort conditions that are independent of price, such as a rule violation detection, a platform malfunction, or a sudden regime shift that invalidates assumptions. These abort conditions are written in neutral language to prevent rationalization. Process primacy requires a reduction of degrees of freedom. You deliberately limit the number of discretionary choices at each step. You standardize order types. You limit the number of simultaneous positions. You fix the maximum number of trades per session, and you restrict the instruments you will touch. You design a small set of valid actions for each state. Before entry, the valid actions are wait, prepare, or execute a single defined order. During the trade, the valid actions are hold, exit by rule, or exit by abort condition. After exit, the valid actions are record, pause, and reset. No other actions exist in the system. You enforce pace as a property of process. You insert mandatory pauses after exits and mandatory checks before entries. You set review windows for system changes so that you cannot rewrite rules inside a session. You define session start and session end as structural boundaries. You end when the boundary is reached regardless of mood. You treat time as a risk parameter equal to price. You convert process into operational language so that every instruction is observable and testable. Phrases like be patient are replaced by remain flat until condition A, and condition B are both true in the reference time frame. Phrases like let winners run are replaced by hold until exit rule is triggered or until a time-based cap occurs. This language removes ambiguity and makes adherence measurable. You elevate checklists from a formalism to a control surface. The pre-trade checklist verifies that environment conditions match the plan and that risk parameters are loaded. The execution checklist confirms that each gate returned yes, and that an error-free path exists to complete the order. The in-trade checklist monitors alignment with the exit protocol and abort conditions. The post-trade checklist records deviations and triggers the mandatory pause. Each checklist is short, binary, and written to be spoken out loud in neutral cadence because speaking stabilizes attention and reduces drift. Measurement is the guardian of process primacy. You track adherence rate, which is the percentage of decisions that satisfied every gate before action. You track deviation count, which is the number of times you acted outside specification. You track average delay from signal to action to detect hesitation, and average slippage relative to planned prices to detect execution friction. You track pause compliance, which is the percentage of times the mandatory pause was respected. You track rule audit outcomes for each trade, so you can separate variance from behavior. These measures are reviewed on a schedule, and the review produces a single small adjustment, not a wholesale rewrite. Goals are converted from money to behavior. A good day is defined as a day where rules were executed without negotiation, risk stayed inside the budget, and low-quality opportunities were passed. You set a cap on the number of trades and treat unused capacity as success when conditions were poor. You remove outcome goals for the day and replace them with execution goals, such as take-only setups that meet full criteria or end the session at the planned time, regardless of the result. Emotion management is integrated as a process step rather than a separate activity. You define a micro-reset routine to run after any spike in arousal. The routine is short and always the same. You breathe to a fixed count. You widen gaze to recover context. You repeat a single operator line that anchors identity to execution, and you return to the checklist. The routine is part of the machine, so it is executed even when you feel calm. This builds a reflex that protects you when stress is high. Attention management is treated as a resource. You restrict inputs to the essential. You hide unrelated instruments and remove notifications. You prevent mid-session, research, and opinion browsing. You operate on the time frames defined in the plan and only drop to a lower resolution to execute timing if that is part of the method. When stress narrows focus, you deliberately step back to the reference view before making any decision. Error handling is codified. A rule violation triggers an immediate halt of trading for the session or for a fixed period depending on severity. The violation is recorded in neutral language that describes the behavior and the trigger without judgment words. You then run a quick correction loop that asks whether the specification was unclear, the environment was outside plan, or discipline failed. If specification was unclear, you rewrite it in simpler terms. If environment was outside plan, you update filters. If discipline failed, you reduce size or frequency for a fixed number of trades as a safety measure. Process primacy also governs improvement. Changes to rules are proposed during review windows, tested on historical data if applicable, forward, observed with small size, and only then adopted. You never mix experimentation with full risk. You keep a change log so you can attribute performance shifts to specific edits rather than to mood or luck. Over time, this creates a stable audit trail that protects the integrity of the system. Finally, you enforce closure. At session end, you shut down inputs. Write a brief debrief that names one strength to keep and one adjustment to test, and you walk away. You do not reopen the platform to relive outcomes. You demonstrate to your nervous system that the machine has boundaries and that life exists outside the screen. This closure preserves attention for the next session and reinforces that process, not outcome, is the source of confidence. When process is primary, you become consistent because your actions no longer depend on how you feel. Your identity is anchored to execution quality. Your edge is preserved by invariance. The market remains uncertain, but your behavior does not. Radical accountability is the decision to place the locus of control inside the system you run. It rejects blame and rejects stories that move responsibility outside your hands. Blame says, outcomes happen to you. Accountability says outcomes pass through your procedures and therefore teach you how those procedures behaved. Blame is soothing in the moment, but prevents improvement. Accountability is uncomfortable in the moment, but compounds power over time. The posture is simple. You accept absolute ownership for preparation, selection, sizing, execution, review, and change control. You do not accept ownership for randomness, but you do accept ownership for your exposure to it. This distinction is the core of professional freedom. When you install radical accountability, you rewrite the contract with yourself across 5 domains. The first domain is specification. You commit to rules that are unambiguous, testable, and easy to execute under load. If a rule produces confusion, you do not blame the market or the platform. You rewrite the rule in plainer language and verify that it removes ambiguity. Each unclear instruction is treated as a defect to be corrected now rather than tolerated. The second domain is adherence. You measure obedience to specification with the same seriousness that you measure return. You calculate adherence rate for entries and exits, for pauses, for risk caps, for session boundaries. A day with perfect adherence and negative money is logged as a strong day. A day with poor adherence and positive money is logged as a weak day. You teach your nervous system what the game actually rewards. The third domain is exposure. You own, and your risk. You own leverage, trade count, instrument choice, and session length. You never attribute a large loss to volatility when you chose size that allowed volatility to harm you. You never attribute fatigue to the market when you extended your session. You treat each breach as a process error and you correct the parameter that allowed it. The fourth domain is error handling. You define in advance what happens after a rule violation. There is no debate with emotion. The violation triggers an automatic consequence, such as a halt for the day, a reduction in size for a fixed number of trades, or a mandatory review before resuming. The language is neutral, so you cannot negotiate with yourself. The fifth domain is change control. You separate operation from innovation. You operate the current specification inside sessions. You make edits only inside review windows after evidence accumulates. You record every change with a plain sentence that states why the change was made, what hypothesis it expresses, and how it will be evaluated. This prevents drift and preserves the ability to attribute performance shifts to specific edits rather than to mood or chance. Radical accountability upgrades the feedback loop. You could have stop asking, "Why did I lose?" and start asking which part of the system allowed this outcome. You classify each outcome along two axes. Was the method applied as written or not? Was the environment within plan or not? Only when the method was applied inside the planned environment do you attribute a loss to variance. Everything else is a process gap. This classification converts confusion into instruction. It tells you whether to change nothing, to improve discipline, to tighten filters, or to clean language. Ownership also extends to attention and physiology because both are part of the operator. You build simple protocols for sleep, nutrition, breaks, and movement, and you enforce them as hard limits on trading days. You do not trade your edge with a depleted brain and then blame the screen. You reduce inputs that corrupt attention. You forbid live commentary streams and social comparison during sessions because they inject foreign incentives into your decision engine. If you choose to consume them, you own the consequences and you remove them when they degrade execution. Radical accountability reshapes language. You delete phrases that transfer control away from you. You replace "the market did this to me" with "I chose to be exposed to this, and I will adjust exposure." You replace "I got chopped" with "I traded a choppy environment that my plan should have filtered, and I will make the filter explicit." You replace "I had to average down" with "I violated the rule that protects expectancy, and I will enforce the consequence I predefined." The tone is not harsh. It is precise. Precision prevents shame because it isolates behavior from identity and makes the next step obvious. Accountability requires a scoreboard that cannot be faked. You track a small set of leading indicators of professionalism: adherence rate, deviation count, pause, compliance, rule, clarity defects discovered and fixed, boundary integrity, and changelog completeness. These are the numbers that predict durability. Money is recorded, but it does not decide whether you are improving. When money and professionalism diverge, you side with professionalism because it is the only lever you control. Radical accountability makes humility operational. You assume that your memory is biased and your perception is selective, so you write things down. You assume that emotion will try to renegotiate limits, so you remove negotiation by writing automatic consequences. You assume that variance will tempt you to edit rules in flight, so you move edits into scheduled windows. You assume that language can mislead you, so you rewrite vague lines into observable conditions. Humility becomes a design constraint that keeps you inside the lane where your edge can live. Ownership also changes how you relate to drawdown. A drawdown is not a crisis. It is a request for clarity. You reduce size to protect the machine. You verify that adherence remains high. You compare realized distribution to expected distribution over a proper sample. If alignment remains sound, you continue. If misalignment persists, you suspend operation, investigate with curiosity, and adapt with one measured change at a time. This posture prevents the spiral where fear edits the system into incoherence. Accountability clarifies identity. You are not the person who predicts the next candle. You are the person who executes a process that has a small advantage and protects that advantage from erosion. You are the person who tells the truth in the journal, who ends the session on time, who accepts consequences without drama, who fixes defects in language and rules, and who returns tomorrow with the same calm rules regardless of yesterday. That identity cannot be taken by the market because it does not depend on price. The practical effect is a quieter mind and a cleaner equity curve. Variance remains, but the left tail is protected by boundaries, and the middle of the distribution is tightened by consistency. The right tail is allowed to appear when conditions align because your capacity was not wasted on noise. Over weeks and months, the compound result is stability of decision quality, as stability of risk, and stability of self-trust. This is the foundation on which all other edges rest. With radical accountability in place, the system is ready for installation of daily practices that keep it honest. The next step is to convert principles into a repeatable set of actions before, during, and after each session, so the architecture becomes automatic under pressure. A trading journal is not a diary of feelings or a scrapbook of screenshots. It is an audit instrument that verifies whether the system you designed was operated as written. Its purpose is to separate variance from behavior so you know when to do nothing and when to change something. Treat it as the control panel of your process rather than a memoir. Each entry begins before the first order. You record the date, the session window, the instruments authorized for the day, the risk budget in absolute terms, and the exact conditions that define permission to trade. You confirm in writing that the default state is flat and that only a complete set of confirmations can move you out of that state. You name the method you will operate today without adding new conditions, and you affirm that any edits belong to future review windows, not to this session. Before the first decision, you write a compact intent line that fixes your role. You state that your job is to execute rules, to protect capital and attention, and to end on time. You include the single sentence that defines what a good day means inside this per system. This primes meaning so money cannot hijack it later. During selection, you capture only what is operational. You note which environmental filters are met, which setup criteria are met, and which are not. You write the planned entry location and method, the exact invalidation condition, the planned exit logic, and the planned position size expressed as a fraction of the daily risk budget. Each item is binary and observable, so it can be audited later without arguments. At execution, you log the real entry time and price, the realized size, and any slippage relative to plan. You confirm that a stop and an exit condition exist in the platform at the moment of entry. If they do not, you mark a deviation immediately. While the position is live, you record only events that matter to rules. You mark any trigger for the abort conditions, any platform or data issue, and any change in regime that your plan treats as a reason to flatten. You do not narrate the tape. You track alignment to specification. At exit, you record the type of exit. Either the invalidation condition was hit, the realization rule fired, or an abort rule was invoked. You log realized risk in units relative to plan, and you record the time between signal and action for both entry and exit. If you hesitated or acted early, you write it in neutral language so it can be counted. You also record the first action taken after exit. If a mandatory pause exists, you confirm compliance with the pause clock in minutes. After each decision block, you run a micro-audit. You ask whether the environment filter was correct, whether the setup criteria were fully met, whether the size matched the plan, whether the stop and exits were live at entry, whether the exit followed the rule with no negotiation, whether the pause was respected, and whether language remained operational. You answer each item with yes or no. If any answer is no, you flag a deviation and state which protocol failed. The journal tags are deliberate. You tag active cognitive protocols such as validation seeking, pain avoidance, or dopamine chasing when you detect their signatures. You tag triggers like fatigue, boredom, social comparison, or compressed time to decide. You tag interventions such as a breathing reset, a forced step back to a higher time frame, or a hard stop for the day. Tags turn vague struggle into countable categories that can be reduced by design. You include a section for trades not taken. You write one line per valid setup that was passed and why. Passing on noise is a positive event, and you want that to be visible. Recording passes prevents survivorship bias and shows whether selectivity is improving. A daily close section ends the entry. You state adherence rate for the day as the percentage of decisions that met all gates. You state deviation count. You state pause compliance. You state total risk used versus budget. You mark whether the session ended on time. You write one sentence that names the single behavior to keep and one sentence that names the single adjustment to test tomorrow. You do not add post hoc stories. You keep it short to preserve repeatability. Weekly, you aggregate without drama. You compute adherence rate across the sample. Average slippage. Average delay from signal to action. Frequency of each deviation type. Boundary, integrity. And the distribution of outcomes relative to expectations for your method. You compare realized drawdown depth and length to the pre-computed envelope for your system. If execution was clean and results live inside the envelope, you change nothing. If deviations drove outcomes, you fix the highest, frequency deviation, with one small rule or one constraint, rather than adding complexity everywhere. If the environment filtered by your plan changed in a persistent way, you consider a planned adaptation to filters inside the next review window. Language in the journal is a technology. You ban dramatic labels and you ban identity statements. You use plain descriptions that an observer could verify. You replace vague lines like felt uncomfortable with operational observations like attention narrowed to a single level and the reset protocol was executed. This phrasing keeps the feedback loop actionable. Data hygiene is part of the edge. You write entries in real time or immediately after exits so that memory cannot distort them. You keep the template short enough that it can be completed every day without friction. You standardize fields so metrics can be counted without guesswork. You back up data and you keep a minimal set of numbers visible on one page so the brain learns what actually matters. Honesty is enforced by design. You compare the journal to the platform statement at the end of the day to confirm that every decision is recorded. If a trade appears on the statement without a journal record, you treat it as a deviation and you apply the predefined consequence. This prevents hidden trades and protects the integrity of the data set that will train your future self. When operated this way, the journal converts pain into information, information into constraints, and constraints into consistency. It teaches the mind that losses are invoices for running a probabilistic business and that wins are byproducts of clean execution. Over time, the pages reveal patterns that you can shape on purpose rather than repeating them by accident. A pre-market routine is the boot sequence of your decision engine. Its job is to move you from a reactive state to an operator state before the first tick has any chance to shape your mood. It loads rules into working memory, sets boundaries, verifies tools, and establishes the meaning of a good day so outcome cannot rewrite it. Begin by restoring baseline. You arrive at the screen with a calm nervous system on purpose, not by accident. You breathe to a steady cadence long enough to feel attention widen and pace slow. You confirm that today you will measure success by rule fidelity, risk containment, and schedule integrity. You speak one line that defines your role as operator of a method rather than as a predictor of price. This line is short and familiar. It signals in your brain, that the session has begun and that identity is anchored. Establish the session container. You fix the start and end time, and you accept them as structural limits. You define the instruments that are authorized today and the specific time frames that carry authority for selection and timing. You set the daily risk budget in absolute terms and translate it into per trade risk and a maximum trade count. You write these numbers once and acknowledge that they are not negotiable later. You declare flat as the default state and confirm that only a complete set of confirmations can move you out of that state. Perform an environment scan that matches your plan. You assess whether the market regime aligns with the conditions your method is designed to exploit. You consider volatility, liquidity, and session structure in the abstract, not as a story, and you compare these to your filters. If the environment is outside plan, you pre-announce reduced activity or no trade. If it is inside plan, you proceed without adding new ambitions. You check for scheduled events that can change liquidity or volatility in your trading window, and you decide in advance whether your method tolerates trading through them or requires a pause around them. You record this decision, so you do not renegotiate it mid-session. Load method specifications into conscious focus. You read the selection criteria exactly as written. You read the entry timing rules and the exit rules. You read the abort conditions that flatten positions when assumptions break. Reading out loud is preferred because it slows the mind and converts knowledge into current operating context. You do not add or delete rules in this moment. You honor change control and keep edits in the review window. Prepare the workspace to match the method and nothing more. You open only the charts and tools that the plan requires. You remove extraneous symbols, commentary feeds, and social inputs. You verify that your order entry panel is configured for the default size and that hotkeys or templates cannot accidentally exceed limits. You confirm that your platform displays the reference timeframe first, so that attention begins wide and only narrows to execution view when timing is required by the plan. Pre-compute the risk map. You translate your risk unit into concrete sizes for the authorized instruments given current volatility, so you do not improvise under stress. You define the maximum session drawdown that triggers an automatic stop for the day, and you rehearse the exact action that will occur if it is hit. You visualize the act of closing the platform calmly at that boundary, so the brain recognizes it as normal rather than as punishment. Prime edge recognition without prediction. You describe in neutral language what valid conditions look like and what common near misses look like. You acknowledge that near misses will appear and that you will pass them without regret. You set the mental posture of wait for the machine rather than hunt for a trade. You commit to remain flat when confirmation is incomplete, even if price moves without you. This primes restraint and protects expectancy. Install pace, controls before emotion arrives. You set a mandatory pause length after every exit, and you set a minimum observation period before any first trade of the day. You choose the number of decisions you are allowed to make in the first hour to prevent early session overactivity. You decide that system changes cannot occur during the session under any circumstance. You state that if confusion appears, you will reduce inputs rather than add them. All of this is written in the journal to remove ambiguity later. Calibrate attention deliberately. You run a brief focus drill that shifts your gaze between far and near points and across chart timeframes to establish flexible attention. You remind yourself to return to the reference view before any decision. You set an intention to ignore micro noise unless the method explicitly calls for timing on a lower resolution chart. Prepare the journal as a live audit surface. You pre-fill the date, the session window, the authorized instruments, the risk budget, and the intent line. You load the checklist, prompts you will speak before any order, and the micro-audit questions you will answer after each decision block. The journal is not an afterthought. It is the cockpit. Set boundary responses in advance. You decide what happens after a rule violation, after the maximum number of trades is reached, after the daily drawdown is hit, and after signs of elevated arousal appear. Each trigger pairs with a single action. There is no space for discussion with emotion because the decision already exists. Run a quick systems check. You confirm data feed stability, platform responsiveness, and order routing. You place a harmless test order if needed in a sandbox or simulator environment before live risk is engaged. You ensure that stop placement and cancellation behave as expected, so there are no surprises later. Close with a quiet commitment. You reaffirm the definition of a good day inside this system, and you release outcome attachment. You accept in advance that the distribution will include losses and boredom. You accept that passing on invalid conditions is part of winning. You accept that ending on time protects the machine. With this pre-market routine complete, the session begins with rules loaded, boundaries set, attention steady, and meaning aligned. You have already made the most important decisions. The rest of the day is execution. Real-time execution is the discipline of doing only what the specification allows, while a position is live and the nervous system is loud. You begin with state clarity. There are only 3 valid states during a session: flat and observing, armed and waiting for full confirmation, in position and executing exits or aborts. You do not invent intermediate states because ambiguity invites improvisation. Before any click, you perform a brief orientation that asks whether the environment filter is still true, whether the setup criteria are still true, whether the risk definition is still intact, and whether the intended order has a clear path from placement to protection. If any answer is no, you remain flat. When all answers are yes, you act once with full commitment to the plan for that trade. After entry, you immediately verify 2 things. The protective order exists in the platform and matches the invalidation condition, and the exit logic can be executed without adding information. This removes the need to think inside the position. Thinking is replaced with monitoring. Monitoring is not prediction. Monitoring is periodic verification that the premises for the trade remain valid. You glance at the reference time frame before looking at the execution chart to maintain context. You speak one neutral line that defines what you are waiting for, so your mind does not search for reasons to interfere. You do not widen stops. You do not adjust targets to avoid discomfort. You do not convert a planned exit into a negotiation. You allow the market to prove the position right or wrong against the specification you set while calm. If price invalidates the thesis, you accept the defined loss immediately. If price fulfills the realization rule, you exit without delay. If an abort condition fires, such as a platform malfunction, a rule violation detection, or a regime shift that your plan treats as hostile, you flatten first and then diagnose. Real-time. Execution uses pace as a protective frame. You insert a fixed pause before any add, reduce, or exit that is discretionary within the plan, so you can scan the higher time frame and confirm that the contemplated action is part of the specification. You keep hands off the mouse between checks. You keep breathing cadence steady. You keep eyes on the reference before returning to the execution view. The pause is short and always the same, so it becomes a reflex. Attention is managed deliberately. You restrict inputs to the few signals that matter to the method. You do not open news feeds or social commentary mid-trade. You do not add indicators or new timeframes to soothe uncertainty. You reduce data when arousal rises, because more data increases noise, and noise increases the chance of breaking rules. Language remains operational. You narrate to yourself in simple present tense what the rule says should happen next, and what action is paired with each condition. You do not use language that invites hope or fear. You replace "I need this to work" with "the outcome is independent and my risk is defined." You replace "it is probably fine" with "the premise is or is not intact." This language keeps the operator in charge. Scaling decisions, if your method includes them, are pre-written and rare. Adds occur only when the market has moved in your favor and only at conditions that increase the probability profile, not at arbitrary intervals or to rescue a position. Reductions occur only at defined points that decrease risk while the premise remains intact. If your method does not explicitly include scaling, you do not invent it in the moment. You treat each trade as a single unit from entry to exit to keep complexity low. Slippage and liquidity behavior are observed without drama. If slippage exceeds a predefined tolerance, you note it for review and you continue to operate the plan for this trade. You do not chase fills or convert a missed entry into an inferior one. You accept that some trades will not be captured at the exact price and that discipline about quality is more important than filling every idea. Real-time risk control is mechanical. You know the maximum number of simultaneous positions and you never exceed it. You know the maximum exposure and you never exceed it. You know the maximum daily drawdown and you stop trading when it is reached without debate. You know the maximum trade count and you end the session when it is reached, even if you feel warmed up. These boundaries convert a chaotic day into a bounded day, which preserves future capacity. Error handling is immediate. If you detect a rule violation, you flatten and mark the event. You do not compound a mistake by trying to repair it with another trade. You execute the predefined consequence for the violation, such as a session halt or a temporary size reduction. The objective is to contain damage and to send a clear signal to your future self that rules are real. Recovery behavior is standardized. After an exit of any kind, you run a micro reset that returns you to baseline. You breathe to the fixed count. You widen gaze to recover context. You read the intent line that anchors identity to operator. You review the checklist before the next decision. This sequence breaks the chain that often links one trade to the next through emotion rather than through plan. Independence between decisions is enforced. Each new action must satisfy gates as if the day had just begun. The last outcome does not alter selection or size. This invariance is the only way a small edge survives variance. Mid-session learning is constrained. You do not diagnose the system while it is running. If confusion grows, you reduce action rather than add experiments. You move edits to the review window where evidence and calm are available. The live session is for execution only. Communication with yourself stays minimal. You avoid fretting about unrealized profit and loss because it tempts interference. You observe position behavior against the rule, and you accept that the market owes you nothing. You do not celebrate during a winner or mourn during a loser because emotional arousal steals attention from checks that protect expectancy. You end trades cleanly. When the exit rule fires, you execute at the first valid moment without micromanaging for a perfect tick. When an invalidation exit fires you, take it with no delay. When an abort exit fires, you flatten first and then write one line about the trigger. After exit, you do not immediately re-enter on the same instrument without a fresh sequence through gates. If your plan requires a cooling-off period after a loss, you honor it to prevent revenge logic from hijacking the cockpit. The final element of real-time execution is closure. You respect the session end boundary, even if the last trade was a loss or a near miss. You close platforms and transition to the debrief container rather than trying to improve the emotional narrative with one more decision. By holding closure constant, you teach the mind that safety and dignity come from keeping the machine intact, not from forcing the market to make you feel better. Under these rules execution becomes quiet. The screen is no longer a referendum on identity. It is a panel of conditions that either permit action or do not. The mind still produces urges, but they are not granted authority. The process runs at one speed. The rules do not negotiate. Expectancy is protected because behavior is predictable. Post-market debugging begins the moment the session boundary is reached. You end on time, or at the risk cap, without negotiation. Then you move from execution mode to audit mode. You close the platform to prevent fresh stimuli from rewriting memory. You open the journal and the account statement side by side, so data integrity is guaranteed. Every position on the statement has a matching journal line. If an action appears without a journal record, you mark a deviation and apply the predefined consequence. You now reconstruct the day as a sequence of specifications and results rather than as a story. You compute adherence rate as the percentage of decisions that satisfied every gate before action. You count deviations and classify each by type, such as early entry, late exit, stop moved, pause skipped, boundary breached, or unauthorized instrument. You calculate pause compliance and boundary integrity. You measure average delay from signal to action and average slippage relative to plan. You note average adverse excursion versus the planned stop and average favorable excursion versus the planned exit so you can detect drift in holding behavior. You record the number of valid setups passed and invalid setups avoided because passing on noise preserves edge and must be visible. With measurement complete, you classify outcomes on a simple grid. Was the method applied as written or not? Was the environment inside the plan or not? Only when the method was applied inside the planned environment do you attribute a loss to variance. Everything else is process. If the method was not applied, you write discipline failure and you select the smallest guardrail that prevents a repeat, such as a longer mandatory pause, a reduced maximum trade count for a fixed number of sessions, or a rule phrased in plainer language. If the environment was outside plan, you write filter failure and you tighten the environment definition or commit to a no-trade posture when those conditions appear. If both method and environment were off, you halt experimentation and simplify. You now perform root cause on each deviation with neutral language. You ask whether specification was unclear, whether attention collapsed, whether arousal spiked, whether tools misfired, or whether fatigue created time pressure. You resolve specification ambiguity by rewriting the line into observable conditions that a third party could verify. You resolve attention and arousal issues by binding the micro-reset routine to a new trigger, such as any deviation flag or any increase in heart rate or breath rate that you can feel. You resolve tool issues by testing order routing and hotkeys in a sandbox before the next live session. You resolve fatigue by reducing session length or by inserting a scheduled mid-session break that is mandatory. You extract one lesson only. You select a single behavior to keep and a single adjustment to test tomorrow. You write each in one sentence. The keep sentence preserves strength and keeps identity anchored to execution. The test sentence names a tiny procedural change that targets the most frequent or most costly defect. You do not make multiple edits. You respect change control because many small untested edits create a different system that cannot be audited. You update the change log with 3 lines. Why the change is proposed. What hypothesis it expresses. How it will be evaluated and over what sample size. You set a review window for this test, so results are not judged by a handful of outcomes. You preserve invariance everywhere else, so attribution remains possible. You adjust risk posture only through rules, not through mood. If adherence was high and results were red, but inside the expected drawdown envelope, you change nothing and you continue to collect sample size. If adherence was low, you cut size or frequency for a fixed number of trades to create space for discipline to recover. If boundary breaches occurred, you impose an automatic shorter session tomorrow or a lower daily risk cap for a fixed period to retrain respect for limits. You finalize the audit by translating numbers into a simple narrative free of drama. You state whether the day was professionally strong or weak based on adherence and boundaries rather than on money. You write the operator line that will open tomorrow. You close the journal and you close the loop. Closure is part of debugging. You deliberately exit the trading context so the brain can consolidate learning without fresh inputs. You avoid platform rechecks and you avoid social comparison because both reopen loops that the closure ritual just sealed. You transition to recovery with the same discipline you bring to markets. You eat. You hydrate. You move. You sleep. You let physiology reset so the next session begins with a full battery instead of a deficit that invites impulse. On a weekly cadence, you roll up the daily audits. You aggregate adherence, deviation types, pause, compliance, boundary, integrity, slippage, and delay. You compare realized distribution to the expected distribution for your method. If realized behavior was clean and the environment was within plan and expectancy still underperforms, you consider method refinement inside a formal review window. You test on historical data, if applicable. Forward, observe with small size, and then decide whether to adopt the change. You document the decision in the change log so performance shifts can be attributed later. Post-market debugging is not about feeling better. It is about keeping the machine honest. It teaches the nervous system that safety comes from rules that survive contact with volatility. It teaches the mind that losses are invoices, that invoices purchase information, and that information purchases better specifications. When this loop runs daily, the system becomes simpler. The left tail is protected, and the edge is allowed to express because nothing in the process is negotiating with emotion. Consistency is built when meaning, method, and metrics all point in the same direction. Meaning is defined as fidelity to specification rather than to money. Method is defined as a small set of rules that stay the same under pressure. Metrics are defined as the numbers that verify execution quality, boundary, integrity, and risk containment. With these aligned, you no longer negotiate with losses or chase relief through action. You operate the machine that converts uncertainty into a controlled distribution, and you accept that variance is part of the invoice for being in the arena. You separate identity from results so the nervous system does not hijack decisions. You think in probabilities so single outcomes do not rewrite beliefs. You make process primary so the plan instructs and the chart informs. You practice radical accountability so energy is spent on levers you control. You keep a journal that audits behavior rather than emotions. You run a pre-market routine that loads rules and boundaries. You execute in real time with pace controls and language that keeps the operator in charge. You close the day with post-market debugging that turns pain into information and information into small adjustments. The equity curve still breathes, but the left tail is protected by limits, and the center of the distribution tightens as deviations disappear. What changes first is not profit. What changes first is how quiet the session feels. You know what you will do before you see what the market will do. You know when to act and when to wait. You know when the day is over. This calm is not an accident. It is the consequence of structure. Your next step is simple. Choose one place to begin and install it. Today. If boundaries are weak, harden the risk cap and session end. If language is vague, rewrite one rule into observable terms. If attention drifts, reduce inputs and enforce the pause. One improvement at a time multiplied by many sessions is how professionalism compounds. You are not chasing perfect days. You are building a system that survives imperfect days without losing integrity. When the machine is intact, the edge is allowed to express, and the long game becomes possible. If this blueprint gave you a clear path forward, mark the moment with a like, so the platform knows this work has value. Share it with one trader who needs to replace impulse with process. To stay with this level of psychological training, subscribe to Flow State Trading and turn on notifications so the next session of this series arrives on time for you. In the comments, write one protocol you will rewrite starting now, whether it is validation seeking, pain avoidance, or dopamine chasing, and write the single rule that will replace it. Declare your intention in plain language and then keep the promise to yourself in the next session. In the next video, we will assemble a compact operator manual you can keep on your desk, so decisions remain stable. When the session heats up, we will compress the principles and procedures into a one-page control surface you can actually use in real time. Until then, protect your attention, protect your risk, and protect the integrity of the system you are building. This is Flow State Trading. Build the system. Trust the process. the results will follow.